Recently, the Bank of Japan decided to keep interest rates nailed to the floor at 0.5%, while slashing their growth forecasts like they're auditioning for a samurai flip. Why? The looming shadow of US tariffs and a global economy that's starting to wobble. This isn't just Japan's drama, it's a wake-up call for your portfolio. So grab your coffee, maybe a notepad, and let's unpack what's going on, why it matters, and how you can play it smart. Let's dive in. Welcome back to the Savviest Financial Minds on YouTube. My name is Steven Spicer, and I've discovered that no matter how many designations I work through, none of them are adequately preparing financial advisors to help you navigate the deeper implications of what's going on here. I'm trying to do that with clients, and I'm trying to help break things down here for you as well. This Japan story is just one microcosm of our massively messed up global financial situation. Anyway, first up, the Bank of Japan's big non-event. Governor Kazuo Ueda and his crew looked at the economic tea leaves and said, nope, we're not touching rates. They're sticking at 0.5%, where they've been since July 2024, after finally ditching negative interest rates in March last year. That was a historic move, ending a 17-year experiment with ultra-loose policy that started back in 2007. But now, they're hitting the pause button hard again. The BOJ's reasoning is straight out of a geopolitical thriller. Uncertainty over US tariffs, global trade disruptions, and a domestic economy that's looking shakier than a Jenga tower in an earthquake. The BOJ slashed their 2025 GDP growth forecast from 1.1% to a measly 0.5%. For 2026, they're down from 1% to 0.7%. What's making them so pessimistic? Well, the US is floating tariffs like they're party favors. Think 25% on Japanese autos and auto parts, plus potential levies on steel and electronics. Japan's export-driven economy, which accounts for about 15% of its GDP, is staring down the barrel. Cars alone make up a third of Japan's exports to the US, and companies like Toyota and Honda could see profits take a hit if those tariffs land. The BOJ is basically saying, we're not hiking rates until we know if this trade war is for real. Now, let's talk about the yen, because it's getting pummeled. After the BOJ's announcement, the yen cratered 1.7% against the dollar, its weakest in weeks. In 2024 alone, the yen was down 8% versus the greenback. Markets heard no rate hikes and collectively shrugged. Well, guess we're selling yen. Lower interest rates mean lower yields, which makes the yen about as appealing as a stale bento box to currency traders. Plus, the threat of tariffs is like kryptonite for Japan's export machine, piling more pressure on the currency. A weaker yen is a mixed bag. For exporters, it's like a shot of espresso. Toyota, Sony, and Nikon get a boost because their goods are cheaper abroad. In 2023, a 10% yen depreciation added about 0.3% to Japan's GDP via export growth. But there's a dark side. Japan imports 90% of its energy and 60% of its food. A weaker yen means pricier oil, gas, and even your favorite matcha latte ingredients. Inflation's already at 3.6%, the highest in a decade, and a sliding yen could keep that fire roaring. Households are feeling the pinch, with real wages down 2% year over year. Governor Ueda is walking a tightrope, balancing export gains against the risk of inflation. Zooming out, this is classic central bank theater. The BOJ is acting like a chess grandmaster who's refusing to make a move. They're worried about more than just tariffs. Japan's financial system is solid. Banks have capital ratios above 13%, well over Basel III requirements. But it's got soft spots. Real estate prices are up 11% since 2019. And rising rates could spike mortgage costs, especially for variable rate loans, which make up 70% of Japan's home loans. Then there's the global angle. Japanese banks and insurers have $3.5 trillion in foreign investments, chasing yields after years of near zero domestic rates. If tariffs tank global growth, those bets could turn sour, and the BOJ knows that. So what's the market's reaction been like so far? A big yawn with a side of chaos. The Nikkei 225 popped 1% post-announcement because, let's be honest, cheap money is the market's favorite drug. But Japanese government bond, JGB, yields slid to a 3-week low of 1.26%. signaling that traders aren't betting on rate hikes anytime soon. Currency markets, though, are a different story. The yen's slide has speculators circling like sharks, with hedge funds boosting short yen positions to a 5-year high, according to CFTC data. Meanwhile, Japan's Ministry of Finance is probably sweating bullets. They've already spent 9.8 trillion yen, $65 billion, in 2024 intervening to prop up the yen. Spoiler, it's not working. Let's connect the dots to the global picture. US tariffs aren't just Japan's headache. The IMF estimates that a 10% global tariff hike could shave 0.7% off world GDP by 2026. China's already dealing with its own slowdown. Exports fell 1.5% year over year in October 2024. Europe's not exactly throwing a party either, with Germany's economy contracting 0.2% last quarter. The BOJ's caution is a symptom of a bigger truth. Central banks are terrified of stepping on the gas when the global economy's engine is sputtering. Even the Federal Reserve is in a bind, cutting rates to 4.5% in December 2024, but signaling caution if tariffs ignite inflation. It's like the world central bankers are all stuck in a group chat, all typing at the same time, what now? But who cares about that, right? What does this mean for your money? Let's get practical. And honestly, like, none of this has been a political commentary. It's just me observing that these moves, these decisions that central bankers and politicians are making have implications for us and for our stock and bond only portfolio. Now, I prefer tactical asset allocation strategies, period, for my market-based exposure. I'll walk you through those in a bit. But if you're trying to navigate this all on your own with that traditional stock and bond portfolio, here are some things to keep in mind, or to make sure your advisor is keeping in mind given this news. First, Japan's a masterclass in why diversification can be your best friend in that scenario. If you're holding Japanese stocks, especially exporters, a weaker yen could be a short-term sugar rush. The iShares MSCI Japan ETF is up 12% year to date, partly thanks to yen weakness. But tariffs could flip that script. Auto stocks like Toyota are already down 5% since tariff talks heated up. Second, right now there's a lot of opportunity in the currency market. A weaker yen makes dollar-denominated assets shine. If you're sitting on USD or US stocks, you're winning against Japanese investors. Japan's import cost spike is a warning. Gold's up 25% this year, and commodity ETFs could be a smart play if global trade tensions keep pushing prices higher. Third, bonds deserve a quick look if you're into that sort of thing. JGB yields are creeping up long-term, but the BOJ's pause keeps short-term rates in the basement. If you're a bond geek, short-duration global bond funds could offer stability without locking you in for the long haul. But let's be real, most of you probably aren't trading JGBs, so focus on diversified fixed income ETFs to weather the storm. And finally, a big picture thought. Japan's predicament is a reminder that geopolitics can move markets as much as earnings reports. Tariffs, trade wars, central bank indecision, those things aren't going away. Build a portfolio that can handle curveballs, even some things that we're not even thinking about now. For that, you've got to think outside the box. I'll cover as much as I can here over time, but you'll also find everything you might need to know to do that for yourself in our Financial Doomsday Survival Guide email series. You'll find a link for that in the description below. And it's worth being prepared for whatever the future will throw our way. And we're seeing more and more chaos. I mean, volatility's up 20% this year per the VIX. So regarding those tactical asset allocation strategies that I prefer for my market exposure, I break down everything you need to know to understand how and why those work in this video. I'll see you there.